All right, we are live and booting up. Let me get the viewers in here. Perfect. All right, we're live. Welcome, everybody. Welcome in to the Micro Moment Trading Investment Show. Every Thursday at 10 a.m. Central Standard, we are here, and it is 10, and we are here again. And we will be next week. So I want to welcome everybody in. Thanks for coming. Lots of stuff going on this week. Lots of drama in the markets. We're excited to talk about some options relations going on. It's interesting to watch everything that happens because everybody's battling over the stocks, and even according to Reddit and according to the articles, and once you really read into it, it's the options that are kind of responsible for all this stuff happening in the first place. You hear about these gigantic options positions and when the shorts are going to be able to hold to, and all these, as you read deeper into the AMC, GME type things, it's about who controls those options and what the price is going to be at when they expire. And that's going to have such a huge effect over the price movement. So I think that's kind of an interesting thing, good to learn about. But yeah, I want to welcome everybody in. How's it going today, Joe? How are you?
Well, I'm fine, Micah, and thank you. We're having a great week with our micro moment. Two trades I don't have, so I had to leave before Tim and Mark did them. But I left. We were at 15.2986 up for the day, so now we're probably 20% up for the day, which puts us through for Tuesday and Wednesday, and so far today, about 122%. Great, fantastic week, and we still have tomorrow to go. And so we've been averaging over 120% on our micro moments. And for instance, today, when I left, they'd only done 4 trades. They were up over 15. Yesterday, they did 18 trades. They were up over 41. And the day before that, they were up 66, over 66.
Nice.
Had about 20 trades or so. So, yeah, we're good.
Wow.
We just try to beat Randy. Randy's our GoPro. So
That's right.
That's awesome, man. A lot of trades going through, a lot of learning. That's awesome.
Yeah,
it's fantastic.
And don't forget, those are trades that are only like 15 seconds, 20 seconds. The long one's 30 seconds, and you're through for the day. You're gone. You're out.
Yep.
So.
Yep.
Yeah, absolutely. For reference, and the percentages are between Mark and Tim. Deshaun is off right now, right? He's taking some time off.
Yes. Yeah.
Okay. Yeah. So those are combined returns from Tim and Mark. And Mark,
that was just Tim and Mark. Yes.
Mm-hmm.
Yeah. I was just clarifying. And then Mark is here. He was.
Well, yes, Mark's unusual. That's him behind the wheel of his car.
Yep.
Yeah.
So I'm a little remote driving.
Hands-free.
Yeah, I got that Tesla. It says you don't have to drive it anymore, so I'm in the back seat. The Tesla letting it drive me.
There you go.
No, just kidding.
You got your bench seat up with the grapes. Yeah.
But like Joe's saying, we had some really good trades. We had some really good market conditions on Monday. We had like 60%, so we really took advantage of that. So the market giveth and the market taketh, right? But when it really is making some good runs up or down, we can really hop in there quickly and take advantage of that. So it's been great.
Yeah. There seems to be a kind of a law of diminishing returns in reverse for micro moment, because it seems that you can catch the little moves very often, but the more distinct they are, the longer they are, the more it's just a little bit easier and easier the bigger that move gets to capture something out of it. Is that fair? Not necessarily even because of the size of the move, but because of how easy it is to read the chart.
The move and the duration, right? So if it's falling, like they call the falling knife, you don't ever want to catch it, they say, right? But if we can jump in there and ride it down, we call it riding a wave, at least I do, and take out as much as we can, or a couple times, in and out, and get a big chunk.
Yep. Yeah, ride the wave. I've been surfing, and it's a funny analogy because of feeling how the wave goes. You get you see it you're sitting on the board facing it. You see the ground drop out, right, and so you just see the surface of the water and then nothing. There's this lull. So you have this sense. You can't see anything yet, but you have the sense that it's coming. And then you start to turn around and paddle, and then as you look behind you, you start to kind of see it come up behind you, and then you time that jump up. So that's interesting mindset to have for trading. Yeah. How's it going, Story Seeker? What is today's topic, guys? Thank you for asking. Today we are going to talk about it. Now, stick with me. We're talking about market direction. I know that sounds vague, but we're talking about market direction in the terms of the way it really relates to movement within stock, right? I've been kind of toying with this thought with the last week of content I've been doing, different things, and I'm looking at the market. I'm looking at all this meme stock speculation, and I'm thinking, man, like all these people are really arguing and really coming at each other, really, and it's always like, the market constantly all this voice, all this like news driving stuff up and down, all of it just to figure out if it's going to go up or if it's going to go down and when it's going to do that roughly. But that's like the market, as vast as it is it going to go up or is it going to go down? And the main question that I have ultimately is, what if it doesn't matter? Or you going to raise your hand, Joe?
Yeah, well, exactly what you just said. Ultimately, it doesn't matter. In our technique, and Randy can expound on his. In our micro moment technique, we don't care which way it's going, because we're trading the volume, and we never look at the markets, but pre-markets to say it's red, it's green, whatever. It makes no difference to us. We're going to make, like, the market was down 100 and something points. That didn't make any difference. We had a great day. It makes no difference to us whatsoever, because we don't look at that stuff. And we only trade the volume. Randy, he can speak for himself on that stuff. But what you had reference today to, which is a good example though, Micah, is today, and I a little bit don't have all the details here, but like AMC, the theater group, had a tremendous run up, and they bought a lot of stock, $300 million worth or something like that. Uh-huh. And it was just going straight up because people could go to theaters now. And then the markets came in and and then they sold. And when they sold, the markets came in there and bid it up much higher, so they left something like $300 million on the table. So they came back in today for $11 million and pre-market, and the stock just tanked. So it's what you're saying. You don't know. You have no earthly idea. Crazy things are going to happen. So,
well, one thing on the AMC thing is it's being manipulated. So it's being manipulated by all those, the Reddit, the Robinhood, all the individual investors that are banding together to try to combat the hedge funds that usually are the ones that manipulate the market.
Yeah.
So they're finding positions that have large short interests, meaning that the traders have said, I think the stock is going down. I'm going to sell it before I even have it. And then they want the stock to go down, and they buy it lower to replace the shares they sold that they didn't have. And so now there's these group of traders that are kind of anti-it. I read a little article this morning. It's almost like the anti-Wall Street of a few years ago, that they're saying, I don't like these guys making all kinds of money in the capital markets because they can, quote, they think manipulate the market because they have all the money. We're going to band together and fight them and make them lose money. So a big part of the goal of all this AMC kind of stuff and GameStop and they just keep going from one to another is they're trying to make people lose money. The people that have shorted the stock, they want them to lose money, and they do that by saying everybody buy it. Well, then the momentum takes over, and other people look at it and say, whoa, it's going up, I got to buy it. And then it goes up and up and up, like AMC hit like 70 yesterday. And then all of a sudden, someone decides they're going to take their profit and they sell. So all those people that were following along, buying, thinking it's just going to go up, now they've lost all their money because they bought it at $60 and $70, and what's it down to 40 side. I haven't looked at it for like an hour, but I think it's down in the 40s. So everyone that bought it yesterday with the big hype, they've lost all their value. Now, if they don't sell the stock, they may not lose their money. But if it doesn't go back up again, then they've lost their money. So you got to be careful of what you're doing. That's why it's what Tim does is fantastic for this market, because it's only in there for a minute or less, and you're not listening to the hype of whatever. You're watching the momentum on the chart that says it's going in this direction right now really fast. Buy real quick and sell real quick and lock in that profit, and then you're back to cash, and it doesn't matter what happens overnight. That's fantastic. Fantastic technique to learn how to do that, and it's only available because there's the intraday streaming chart.
Right.
If we didn't have the intraday streaming chart, that kind of return with that track record is not available. Then you're just shooting in the dark. You're just speculating like everybody else. But with that intraday streaming chart, which is proprietary to micro moment trading, that is what gives you the leg up to have high confidence that what you're doing is going to be a profit. It's not a profit 100% of the time, but it's very, very high confidence that by watching that chart, following the rules that Tim teaches, you got to follow the rules, but you're in and out in a less than a minute, and you've locked in your profits. And you can do that, as Joe said, no matter what direction, whether the stock's going up or going down. It just matters, are you buying a call if it's going up, or are you buying a put if it's going down? Now, like Joe said, I do it a little bit different technique. I do that, although I haven't done today because this market is so crazy. At 10:45 today, it took an about face reverse. I mean, it didn't just start to change, it just about face. I don't know why, but that's the kind of thing that today has me out of kind of like doing those types of trades. But what I do with covered calls is similar, but it's a longer term. Like Joe said, I don't care if the market goes up. It's great if it does, then it's 100% for sure. I don't care if it goes sideways. Great if it does, because it's 100% for sure. I don't care if it goes down, because I sell in the money, deep in the money covered calls to generate the income, whether the stock goes up, down, or sideways. Now, if it goes down substantially, which we might be getting to that area, although now, I mean, the S&P is almost back to even, and it was down like 30 points. But if it goes down substantially, it's okay, because I have management techniques, it's what we call them, to implement to work the order, work the position, creating more profit as the equity goes down, and then exiting the equity to get all of the capital back at a lower place than where it was when you entered it. And that's what makes the process, it's an entire process. It's just not buy and hope that it happens. It's selecting, and that's number one, is selecting the appropriate position. And we have the buy and low rule. So we're entering positions that have the longer term rising record, and then we want to buy it when it's low, sell a deep in the money covered call at a profitable position, and then wait for the outcome at the end of the week, and only in for a week or a day. Like I've already entered a couple positions today, this morning, when the market was down. Now it looks like we're almost going to go back to green. That is perfect for the covered call. I'll get called out tomorrow, lock in all my capital return, and have a return over 10% for the one day. And but it all comes from learning the rules, learning how to read the chart, learning how to enter the positions, and then learning the management process that allows profits to even be made, even if the equity goes down. The desire, of course, is for it to stay even or go up. So we're trying to select positions that look like they have a good chance of going up, but they don't have to go up. We're not speculating. We're not saying, oh, it makes a profit if it goes up. No, it locks in a profit if it goes up, locks in a profit if it goes sideways, and even if it declines, a reasonable amount. If it goes down more than that, sometimes that's even better. In fact, a couple of years ago, I think the kind of record for a good one was Broadcom. Broadcom was trading in the like $400 range at the time, and I entered a covered call at the $250 level. That would have provided about a 10% return as long as Broadcom stayed above 250 by the end of the week. It was trading over 400. It dropped $200 the next day.
Wow.
I implemented the management process, and the following week, I closed the position out, got all of my invested capital back, and generated 31% return on my capital. And it never got back up to 400 at the time. It only went back up to 250. And it was fantastic, but it was because of the management techniques that allowed us to be able to do that.
Wow. What a
Great stuff, right?
That's what's-
Awesome.
that's a trade.
But
That is
Randy's
a whole trade.
got a technique for everything, no matter what the market does, up, down. He's got enough rules and regulations, and that's what he teaches. That's why he's so successful teaching those one-on-ones and all that kind of stuff. Where Tim and Mark and I, we only got one rule, which is good for us because that's all we can remember.
That's right.
It's one rule: get out, get out, get out.
Mark, I saw you on mute. Were you gonna say something?
No, I just said that's phenomenal because with the techniques we have, and I've done those before with our calls and everything. We have so many different techniques that allow us to profit depending on the market trend or market whatever it does changes, whatever it moves. Either way, most people say, "Well, it moved against me." Well, that's okay. We've got to take that.
Yeah.
Ideally, though, we'd love to be able to sell the cover call, get called out, move on, do it again. But we don't always rely on that. That's why we have the techniques that we have. And then, of course, with the micro moment situation, we're in and out. You don't hold anything overnight. So by the time you get done trading or you go to bed, you can sleep like a baby, wake up, everything's good.
I think this is so cool. This is the first time we've ever had one of our folks in a car doing the, video podcast. So.
Yeah, absolutely. Mark on the road.
I was going to try to trade too, but I decided not to.
Yeah, so I want to clarify something. It's not that it doesn't matter that it goes up or down. It's that we care about what it does, and we can still identify directional things, right? It's not that we're building a position that says, well, if it goes up or down, then it's going to be profitable because it's this magical thing that just makes money, right? It's that there's a lot more in the market than a buy and a sell. You can buy a stock and sell a stock, and that's required for a lot of these techniques. But there's a lot more to it. You can spend any amount of money, you can spend any risk of money, you can really sort of tailor these things to you and your trading. And that's what we mean with the management techniques is you have this underlying stock value, you have options on top of it, which options, if anybody is super new here, options are the right but not the obligation to buy a stock. So they're contracts that control, basically they're the controlling interest of a stock. And if you look into, if anyone's new to options here, I encourage you to look into just the basics of what they are. There's some really good simple YouTube videos that are like 3 minutes that really explain the fundamentals. And it's kind of like once you get a car, you see the car everywhere in town, you're going to start to notice things about how options are affecting the market that you may not have before. And you really will. I mean, I was reading a bunch of stuff on AMC, and a large majority of it was, well, it's gonna go up, it's gonna go down. The stock is doing this because of these fundamental things. AMC is not doing anything because of fundamentals. I think we've discussed that, but they are talking about who's short, how they're using the put options to do those things, and how they're using options at the core of these meme stock movements anyways. GME only launched because of how many calls there were ready. And if you're not sure what a call is, that's why I encourage you to look into that and get a basic understanding of those calls and puts. We have some different resources here as well that we can teach the basics of options. But GME was a matter of what was happening on the option chain. Now we don't play things like AMC or GME. We play things like Apple and QQQ and SPY, SPX, a little bit on the VIX from Randy. And those are things that will not take those massive fluctuations. We don't want that high of a risk because you don't need it to get that much of a return. But I want everybody on here to be aware of the power of options and how much control they have over the market. And I mean, it's just massive. Yeah. And then whoever is willing, could you explain really quickly for people's knowledge so that they know what's going on, the difference between a short and a long, and why don't we just call it a buy and sell? Why are we short and long? And then what a call and a put are, if anybody's.
Well, I'll handle the call and put, since that's kind of in our wheelhouse, and I'll leave Randy to explain the rest.
Could we do long and short first? That might be
okay.
Sure.
I'll do long and short, and then Tim can do puts and calls, because that's what he does. I mean, all day long, either a put or a call.
Yeah.
Exactly.
We in covered calls we use calls,
Yeah.
but Tim uses calls and puts depending on the direction at the moment. But long and short, if you own something, you're long. So if you buy stock, you're long the stock. So you're expecting, when you buy a stock, you're expecting it to go up. Otherwise, you shouldn't be buying it. And so you're long it when you buy it. Being short something is you're selling it. And in the case of a stock, some people actually sell stock they don't have, and that's called shorting the market. And in essence, they're supposed to be borrowing the shares. Their broker's supposed to say, it's okay, Randy's got those shares over here in his account. So
Oh no.
I just knocked over my water.
Uh-oh.
So yeah, luckily it wasn't near my computer. But
Oh good.
So
that's a close call, not a cover call. But.
Exactly, yeah. So the
good.
broker is supposed to control that, to say, okay, over here in this account, I've got those shares, so we'll kind of loan those shares out to Steve that wants to short them, so he can sell them. Now, Steve is hoping the stock is going to go down, so that when he sells them at, say, $20 right now, he's hoping it's going to go down to 15. Then he can buy the stock at 15, and therefore he's already sold it at 20. So then he covers that short position by buying the stock back. And that's what leads to things that are called the short squeeze, which is what's happening with all these Reddit things like the GME, the GameStop, and the AMC, is a lot of people, and that group, that Reddit group, goes to try to find stocks that are heavily shorted, that have lots of people that have sold them because they think that company has no good business plan. Their company is going down, so let me sell it high right now, and I think it's going to go down. So they're shorting it. So then this Reddit group is saying, aha, you're shorting it. We're going to go buy it and make the price go up. So when they buy it and make the price go up, the people that sold it already, that have to buy it back to cover the shares they sold, they go, uh-oh, we're in trouble. We better buy it now to quit losing more money, because if I sold it at 20 and it's trading at 25 now, I've lost money. If it goes to 30, I'm going to lose more money because I sold it at 20, and if I have to cover it, I have to buy it at 30. So then they buy to cover their shorts, which makes the stock go up even more, which makes other people that shorted it have to buy, and that's called the short squeeze. And that's what they're all hoping is going to happen with the AMCs and the GMEs, is if they keep buying it, and as long as they can keep finding people to buy it, the price is going to go up. and then the people that are short have to buy to make it go up even more. The problem is, at some point, there's nobody left to buy, and then those kind of insiders that are kind of watching everything, they say, okay, now we're selling. I don't know if you ever, what's it called, trading places, or what's it called? There's that great movie with Eddie Murray and
Trading
Dan
places.
Aykroyd.
Yep, Trading Places.
Yeah, great. That's a
Where
funny
the
movie,
Bellamy and is it Amici, that
Amici,
they're the
yeah.
ones that are trying to corner the citrus, the orange options market, the commodity market. And so Dan Aykroyd and Murphy switch the tables on them and give them the wrong report. And so it says it's going to be good. So everybody's selling. And so they're going, yep, I'll take it. Yep, I'll take it. Yep, I'll take it. And Eddie Murray and Dan Aykroyd grab all these shares. And all of a sudden the report comes out. It's the opposite of what they thought. And it starts tanking. So they go, yep, I'll take that. Yep, I'll take that. Well, then Bellamy and Amici, they're the ones that were spending all their money to buy, and all of a sudden the price is going almost to zero. And then they go, turn those machines back on, turn the machine. But there's nothing left to do, is because the insider knew, okay, this is the high. I'm now selling, and they're taking all their profits. And the problem is that individual investor, that all they're doing is trying to listen to somebody else. They have no clue why they're doing whatever they're doing, but they're saying, well, they say to buy it, I'm going to go buy it. They don't know when to sell it. And so all of a sudden, those insiders, they start selling. And then what? AMC dropped $20 or $30 this morning or something like that. I think the exchange actually halted for a while because it hit those levels. They have safety stops that says, we got to halt for 15 minutes to let everybody catch up. But that's because the ones that were saying buy it back when it was like at 30 yesterday morning, they're sitting there holding, everyone's buying it, it's up to 70. They say, I'm going to sell it now. I'm doubling my money. I'm taking the profits. They didn't tell everybody else to go out and sell it yet. So then it drops substantially, and then people start panicking and start selling for a loss. So we don't do that. We follow some fundamental and technical positions. We want fundamentals to be good, solid, quality companies. And then the technical part, that they're in a rising cycle and try to get in at the lower 25% of a company that has good long-term prospects, not ones where there's just a bunch of hype about it. But that's what's happening with the long and short. So when you buy the stock, you're long. If you're selling the stock, then that's going short, especially if it's stock you don't have. And that's the risky part, is if you're selling it hoping that it's going to go down and it doesn't go down, you can lose really unlimited amount of money depending on when you decide to pull the trigger to buy to cover what you sold that you didn't have. So it can get really risky if you do that. We don't. There's nothing in any of our techniques that says sell stock short. Absolutely nothing.
Yep.
And so if you think that something's going to go down, the thing to do is what Tim's going to talk about, is just buy a put.
And that's the core of why a short squeeze can work too, right? Because if you go from 50 cents to $1, that's a great. I mean, sorry, if you go from, say, 50, well, we'll keep it round. Say you go from $1 down to $0. You're at $1 and then it gets worthless, right? You lose 100% of that dollar.
Yeah. Yep.
But if it goes from $1 to $2 to $2.50, you're now inverted. And then it can go to 3, it can go to 4, right? Upside is exponentially higher. That's why we set our entire trading method to be that way, and that sort of security, right? You can't lose more than 100% in any situation. I mean, we don't go about losing 100% time, but it's much smaller. But it's putting that on your side so you don't get inverted and you don't have just that ultimate, right? That you don't want that sort of mind game going on in your head. And that's where that short squeeze comes from, ultimately. Yeah. I mean, we're living in a time where stuff is going up hundreds and thousands of percents in weeks, and and it's just, I mean, it's getting commonplace to see stuff up 2,000% in 6 months. It's pretty interesting. I don't know. But,
Yeah, and there's short squeezes going on, every day, because there's always someone that thinks it's going to go up, and there's always someone that thinks it's going to go down.
Mhm.
That's what makes the market. If everybody thought exactly the same way, there'd be no buying or selling, and there would be no market.
That's
So you have to have people that think it's going to go down, and they short it in order to make the market so that it can go up. The key is having some kind of education and knowledge that helps you try to identify the proper process to be using.
Yes.
And so with my covered calls, typically in the market, covered calls are not done the way that I teach how to do them. That's because covered calls are kind of a afterthought in the market. It's kind of like, well, I'm not making any money, so I might as well sell a call that maybe I'm going to make some money. That's how the market looks at it. With our techniques, the covered call is a deep in the money covered call that still has a profit if it's called out. The goal is to be called out. Being called out means you get all of your money back, and if you set it up as a profitable call out, you not only get all your money back, but you get a profit at the same time. And that's how we construct the position. And being deep in the money, that means that the strike that we're going to sell the stock at is lower than what we bought the stock at, but it's still a profit. That because of the premium, because people have to pay a premium to buy those calls.
Yeah.
That's what makes the process work. So we're not speculating that says, oh, the stock has to go up in order for us to make a profit. The preference is for it to go up. That's great. But it can go up, it can go sideways, it can even go down, and we still have locked in that profit that we started with. So that's what makes our process it's different than what everybody else in the market teaches, and it's more conservative because it allows the stock to still go down, because stocks go up and down. You and I and maybe even Joe, he has a little bit more money, so he might, but we don't have any control over whether the stock is going to go up or down. Okay, those people that are trading millions of shares, they have a little more control, because if they're buying, the price is going to go up. If they're selling, the price is going to go down. But we're not trading millions of shares a day, and so we don't have control over the market. What we have control is, can we generate income on the direction that the market is going? And
based on the technique.
Yeah, based on with my in the money covered calls, it generates income whether the stock goes up, down, or sideways, because it's going to do those every single day. And so the key is, again, selecting the good, solid, quality company, not the GameStops, not the AMCs, not all these stocks that are just driven by the word of the day, so to speak, but good, solid, quality companies that are probably still going to be in business next year and the year after, and they're probably going to be growing their business next year and the year after. And at least by having those good, solid, quality companies that are in a rising trend, that even if it goes down in the short term, there's a good chance it's going to come up in the longer term. So it's critical not only to use the proper process, but also to learn how to do the process in order to be successful. And that's where we come. We actually have coaching every week. Tim does it every morning with his process and technique. And I have coaching every Wednesday morning and every Thursday evening for learning the process and teaching how to do it and answering questions about how to do it.
But Randy, every single day though, when we're over there teaching the micro moment, and Tim's doing his stuff, and Mark's doing his stuff, you're over there doing those your version of everything, the cover calls.
Yep.
And you're sending out daily every trade you do, so people are when they participate in your service, forget about the one-on-ones, they get your trades every day.
Yep. That's part of the coaching service is I actually use my positions to teach, to be able to show you. I'm not just saying this is what you could do or this is what you could have done last year Or if you would have done this in the last 5 years, here's the back test of the process that's never been done before, but we back tested and you'd be a trillionaire. No, I teach with actually doing the process live in the market so that you can actually see the results firsthand right there. Not this is what last week would have been. It's here it is right here and now. And I go through every single step as it's supposed to be done.
And you've got me totally absolutely confused on the squeeze stuff. I thought a short squeeze option trader was a female short person.
Yeah, squeezing some.
And the long one was a tall squeeze.
There you go.
Yeah.
Up and down.
Yeah, that goes into these things.
See, that goes along with Joe's pole dancing, you know. But no, we don't do that.
There you go.
One from Joan. Hi, Joan. Hello.
Yeah. See, now you've got Joan all excited. Now she's
right.
speaking up. She says,
right.
"Come on, Joe. Come on, Joe."
So, and that's I guess that's not primarily the upside. So there's the clarification we were looking for. Is the we don't play the short side of the market, Randy, as you said, correct? At all.
No. Not with the cover calls. Now, Tim.
Yeah.
Tim will talk about how can you still make money when it's going down without shorting.
Why does it
the stock? Because shorting has a lot of shorting is shorting is risk. There's risk to shorting, and
it's expensive.
Yeah, it can be very expensive. But by what Tim's going to talk about with calls and puts, you can still profit from something going down without shorting it. So now we can have Tim explain calls and puts.
Yes. First off, thank you, Randy. You are the master explainer. No, I love when he explains his technique, just the clarity, and I really appreciate that. Ours on the other side of the house on Micro Moment is much, much simpler. Our only management tool is to get out when it turns. But let's get back to the main question, which is, what is a call? What is a put? So a call.
Got a comment for you, Tim, really quick.
Tim is trading. He's not paying attention. That's Marion.
You can watch our eyes and our heads move as we go, because that means we're looking at our charts and we're analyzing positions even while we're trying to talk and pay attention. But sometimes we kind of get enthralled in what's going on in the market at the time. So Tim is always looking for that next position.
Absolutely. So we just had a really nice little push down here on Apple, which I grabbed 8 cents from. And I'll give that to Joe.
8 cents. That was huge. That's great.
Yeah, 1 to 108. Anyway, so what do we do on this side? We buy calls. We buy and sell calls and puts. And what that means is when we buy a call, we're simply and Micah gave us a great explanation for this. We don't buy stock. What we do is we rent it for 15 to 30 seconds. And when we make a trade, we buy an option call. We have the right, but not the obligation to exercise that and buy the stock. But with Micro Moment, we don't ever buy the stock. We simply buy and sell options on a very short period. We're looking for very short little turns. So a call just simply means that we're expecting the option price to go up. And when we buy a put, we are expecting that the price will go down of the underlying stock. In our case, what I do is Apple. And that is really simply it. We don't buy stock. We just rent an option for under a minute. So we're in and out of our technique very quickly. With Micro Moment trading, what we do is very disciplined. We have one very, like we said, we just have one rule, and that is if we buy a call and that price starts to turn down, we get out of that. We sell it as quickly as possible. Our goal is to keep our losses 1 to 2 cents. The profits take care of themselves. If we follow this rule, the profits automatically take care of themselves. Again, if we buy a put, the ticker on our charts, and again, this is really only possible. We have the success. I mean, we're over 100% on 3 days of trading. I don't know anywhere else other than Randy where you can have these kind of returns. And the main reason we have these returns is that we have our intraday streaming service, our charts, which gives us a little bit of a crystal ball. Okay, no one can predict the future, but the way that our charts are set up graphically, we can see trends. We can see when a cycle is turning, when the momentum is turning. And we get a hint of what's going on before most people do. And the way that our charts are laid out, it's very, very easy to glance at our charts and get a complete idea on what's going on. Should I be getting into a call? Should I be getting into a put? It also tells us exactly when to get out.
So Tim, how do you, and Mark, if you're willing, how do you exercise on that that discipline? Like what's really the mindset that you keep when trying to exit a trade quickly enough? Because you just mentioned like huge returns and nothing about getting them. You said the main focus is exiting, and the returns, the positive returns, take care of themselves. That's a much different story than most people are talking. So could you explain that mindset a little bit?
Sure. With our charting system, we can see a strong directional move. Our tick is yellow. We can see it moving very strongly in a direction. When we're outside of the, I'm sorry, got a disturbing call here. For instance, Apple right now is in a real strong push toward the put side, and it's moving outside of the Bollinger Bands. When we see a strong vertical angle on our tick and our underlying E lines agree, we know it's a good time to get in. When we continue to see, and when I say the profits take care of themselves, as long as that price is continuing to move in that direction that we're hoping to move, we're going to stay in that trade. And we can start to see exhaustion of that move by our tick, and we can get out. So when I say our profits take care of themselves, when we get into a trade and that line keeps moving, we stay in that trade. We know our profits are locked in. We love puts. They go very fast. We tend to, cover the spread and our fee very quickly, and we're into profits.
Yep. That's a really valid point too, because when you enter kind of any trade in any market, you enter at a loss, right? Because you're down a commission or a spread or both. Right. So one thing he means by that micro moment is when you're zoomed in that granular and you're honest with yourself and disciplined, then you will know in a few seconds if it's not going to work. When you zoom in on a smaller part of a much bigger move, it's a quite a bit more stable, right? Yeah. If you zoom in, right? If you see that the whole line and it's up and down, all this craziness, but if you zoom in, it really slows everything down. And so having that control over the immediate response, I think is huge, and the immediate feedback from the market, because sometimes I feel like there's a lot of times people enter positions with a plan. We talked about this a couple weeks ago, your trading plan, right? Really sticking to it, because you can enter something with a route for it in mind. Well, I'm gonna sell it if it does this. I'm gonna buy it more if it does this. What if it doesn't do either thing, right? Because we think like the market's going to go up or down, but it's going to do a combination of that you never saw coming first. It's it'll wiggle up and then drop and then boom, and then some instant reversal on a Fed news. And then it's going to just steady ride up for the next 3 days without a break. If you're SPY, right? SPY can just like 10-degree angle up all day and never blink. So I think that's absolutely huge to be zoomed in enough where you have in 5 to 10 seconds, you have a feedback on whether you're going to already be regained on your commission and your commission and spread.
Right.
Yeah, Michael. Well, one thing that helps him and Randy is that he is so leveraged without the use of margin. He's not borrowing any money. He's so leveraged that he doesn't. A penny or two is a huge return. Like today, he was into some apples for like 72 cents. My goodness, it doesn't take but a couple pennies on 72 cents to have a good return, and he's out. And commissions are zilch to nothing. There's some other trading costs there, but they don't amount to much. So that's why I said extreme leverage versus going out and buying, Apple for a couple of $100 a share, and then trying to make money on it's very difficult. It's like what you're saying. You have to kind of wait. Where he's in there whammo, and when he teaches people to do micro moment, he teaches them that chart because that's the key to it. That chart tells you those little red and green lights. When that sucker's green, you're in, and you get out after you got a few cents profit. When it's red, you're out. You get out just as fast as you can. And
if anybody wants to see this in action on our micro moment, I'm up to like 60 videos or something like that of we're zoomed in all the way on this chart. Usually we have three across the screen. You usually trade Q, Apple, and SPY. And we just zoom into one chart, and some of them are 30 seconds long even, but we just show the individual trades to show what we're talking about. And we're really zoomed in on the chart. You can see each line moving and the crossovers that we look for. And they explain them in real time. There's a ton of free knowledge on there. So even if you don't have TikTok, you can still watch the videos. If you just search it on Google, I would recommend that for sure.
You've got another link on that on the Facebook page where you can get a couple of weeks free of the micro moment. And I don't know, Randy probably has some free couple of weeks too.
Yep.
You don't?
No.
Okay.
No, but we have introductory pricing
Yeah.
that you can get into the coaching sessions. But I want to add a little bit to what Joe was talking about, because he talked about leverage. We do leverage different than what you hear about in the market. Options allow you to trade with leverage without borrowing any money. Now, when you typically hear about leverage where this hedge fund takes in $1 billion, but they go out and borrow another 50 billion and they trade 51 billion. They leverage the 1 billion to borrow more money to go out and trade. That is crazy. That is so risky that it's unbelievable. We use leverage in that instead of buying the stock, we buy the option, where the option might cost $3 for a stock that costs 150. So you're able to control a position in the stock. You're not borrowing any money, but you're controlling it with $3 instead of controlling it with $150 of buying the stock. Mm-hmm. If you buy the call, it gives you the right to buy the stock at a set price until the expiration, a set date. You can decide if you ever want to actually buy the stock. We don't. We just buy and sell the option that goes up and down with the price of the stock going up and down. So that's when Joe talks about leverage, is we're being able to trade in a position using a little bit of money compared to the high cost of the equity and still be able to generate great returns. We're not borrowing any money. We don't work on margin. That's the worst thing you can possibly do. We're just using the capital we have, but we're leveraging the buying power of the capital because we're using options instead of the actual stock.
Mm-hmm.
Right.
I feel like if you're talking about leverage in the form of a physical lever, margin is like pressing harder on the end of the short pull to try to lift the thing. Right? You're on a short pull, you're on a leverage point, and you just press harder and harder and harder and harder with margin. True leverage is making a longer pull, right? Getting farther away from the point, so you have more leverage to lift. I think that's a lot more what the type of leverage you should aim for. Margin is not leverage.
Margin is borrowing money.
Yes, and there's this concept that margin is leverage. and it's not. It's just money. It's flat money, right? So you can push harder on the shorter stick. You can try to undo the bolt with your fingernails, or you can get a wrench on the thing. Get away from it a little bit. Zoom out. Give yourself some wrist protection. Protect your hands from breaking with things like management techniques. Get a little bit of space.
You're becoming radical.
I am. Maybe. Use a wrench. I'm radical. Yeah. Kim's wondering, is there any chance I can speak to one of you on a phone call? Do we have a micro moment phone number? I guess that'd be a question for Joe.
Sure. They give me a call. Give you that number. Whenever I do the 2-day, I always give a number. And but call me during market hours. And that's not right now.
No, Joe. Call them during morning market hours.
Morning
Before lunch.
Yeah. And that number is 817-739-8989. 817-739-8989. And don't do it unless the market's open. And because you may have some real innocent question, but it's better to give examples and talk when it's open. But just call me in the morning. Okay.
Yeah.
So, yeah.
Awesome.
Yeah. For those that are old enough to remember, Joe's like the Maytag repairman.
Right.
In the old commercials, because they said Maytags were so good they never break down, they always showed the repairman just sitting there at the table going, "What am I going to do now?"
Yeah.
That's like Joe. He's waiting for someone to call him in the morning so he has something to do.
That's
so,
right.
So he's anxious for your phone call.
Okay.
Well, Kim was still on, and she said thank you.
Okay.
Excellent. Any other questions at this time? We're about wrapping up, so feel free to drop them in there.
Yeah, well, let me ask you, Tim. Did you do any deals while we've been sitting here talking?
Yeah. Yeah. I'll send you. I'll send you the trades.
This happens all the time. So he gives me those deals. He'll text them to me after a while, and then I count it tomorrow. So I'll start off tomorrow with some already done deals. So.
Yeah. Apple's just been moving quite a bit. A lot of great volatility this morning. It was a great drop a few minutes ago. That was nice.
The market since 1109 has been back into a downtrend here. So
yeah,
good trading.
I was looking at the chart of AMC. Opening at about 60, pops up to 63, and then for 15 minutes dropped $15 down to 44, and then 15 minutes later rebounded to 57, then dropped to a low of like 41. Wow.
Man, hang on there. That's a wild horse. Yeah.
That's all those long and short people trying to figure out what they need to be doing. And when you got something that's going like that, just hold on to your shorts. That's and I'm not talking about. Yeah,
I don't want to play that game.
Yeah, that's crazy.
Hey, Mark, that's crazy. You've been awful quiet. You didn't leave the exhaust hooked up to that hose again, did
you? Well, you guys are kind of breaking up on whatever signal I've got here, so it's been kind of hard to hear a little bit. But
is this the correct phone number, Joe?
817-73. Yes, it is.
Perfect.
Yep.
Awesome. Thank you, Kim.
Okay.
Yeah, absolutely. Thank you for being on, Mark, too. I appreciate that for making it happen. Anyways, we appreciate hearing your voice.
Mark is just kicking butt on Q.
Yeah.
You know, and here's the thing: is Everyday Joe kind of
it has its moments. Today wasn't stellar, but it was
Yeah, but here's the thing: Everyday Joe always says, "Well, you know, it's kind of spread evenly. Tim had 7, and Mark had 8." I'm trading most of my stuff under $1, and Mark is trading most of his stuff at the $3 range. So he has to do 3 times as much. That's how you have the same percentage.
Percentage return is the
Here's a good example. Yesterday they made 41.8367%. There were 8 apples and there were 10 Qs, The returns on the apples were 20.1944, and the returns on the cues was 21.641. So yeah, virtually the same. So,
Yeah.
Nothing like a little friendly competition, man.
yeah.
Now
Yeah,
he's
but
Mark,
just
Mark
it's
is-
more. I have more capital on the table when I'm doing this, percentage wise. But yeah.
yeah, he's kicking butt. He's doing great. He's doing a great job.
Yeah. For reference on anyone new to options, that would boil down to if you're at $1, it's going to be about the options come in groups of 100. So $1 would be about $100 per share. Something like 315 would be $315 per share. And you can just buy one. So you can buy an option and spend $200 and be in a trade, and then you can close it. Obviously, is it worth your time? Not sure, but for learning things like that, you can spend $100 on an option and then control your size very granularly too, right? You don't have to be like, well, I'll either go in 3,000 or 5,000, right? You can,
I mean, literally, you can put $500 in the account and get started on options and learn everything you need to do. You risk very little money.
Yeah, let me always repeat this. I know everybody gets tired of it, but because of the leverage, you take $2,000, put it in a virtual trading account. This for a young person, put in a virtual trading account, which you don't risk anything. And if you just got following Tim and Mark and even Randy, if you just get 7% a week, now they're up over 100% a week. If you just get 7% a week in 2 years of trading, you've got $850,000 in cash. Never putting any more in the money on the account other than the $2,000 originally. And you can do it virtually. So until you learn it and you're successful virtually, which is the exact same thing as trading real money. Fantastic opportunity, particularly if you're young and you just don't have a bunch of money. Like Tim.
See, but that's an important thing though, is this doesn't take hundreds of thousands of dollars to trade.
Right.
Just it's $100 or $104 to get one contract with what Tim's doing, or $300 for what Mark is doing. Most of my positions, one contract worth is going to be $90. Mm-hmm. So you don't have to have a fortune to be able to learn the process. Virtual trade, you don't have to have any money, but when you start trading real money, you don't have to have a fortune. And when you can generate 4, 5, 6% a day or 10% a week, then your money will grow pretty quickly, and you're not risking a fortune to do that, and you don't have to be a trillionaire in order to learn these processes. So that's what makes learning how to trade with the options so nice, because you don't have to have a whole ton of money in order to get started.
It only gets better, because a long time ago, 27 years ago, when Mark and I were doing this, you paid huge amounts of commissions. You didn't have the trading platforms. You didn't have any of the stuff. And over all these 15, 20 years, all that's happened is all the authorities have just made things better and better and better. Now we don't have commissions, and things have just gotten better. And a long time ago, Mark and I were saying, look, let's make 3% a month. Let's make 3% a month. Look how huge that's going to be, 36% a year. And now they make 3% on a trade, or if they're doing Randy stuff, they're making 5% several times a week, not just once a month. And so it's just huge opportunities for everybody.
Oh yeah, the introduction of weekly options has just certainly changed the whole landscape of how you can generate income on a daily and weekly basis, because now you have options that have very little time value to them, and where before you had to pay lots of time value when it was a monthly expiration. Now with weeklies and some equities like SPY actually have like almost daily 3 times a week expiration. So it's
which, I mean, 2 days out is just as volatile as 1 day, honestly.
Yeah, every step that the options board has done has increased the ability to use our techniques and generate more and more income. It's made it easier, it's made it cheaper, and it's made it even more opportunity for a profit.
15, 16 years ago, there was only
weekly
third Friday. That was it.
Yeah, that was it. Plus, everything's in newspaper, right, Joe? I had to look at the newspaper, call poker.
Yeah, you
right,
look
right?
you look the following day to see how your stock did yesterday.
Right.
That was the first
That's
thing
right.
you did.
Yeah.
You got the business section and you start going through and writing down what was the price yesterday,
Yeah.
because that was the most up to date news that you had.
Everybody was paper trading, even if it was
Right.
real money.
When you hit
Yeah,
that send
yeah.
button to send that order in, sometimes it would take 2 or 3 minutes. Yeah. So
Yeah. That's funny.
Awesome.
Alrighty, guys. Been on for an hour. We are closing it down. Thank you for all the comments, all the interaction today. Marion, it's good to see you, everyone. Kim, thank you for being here.
yeah, Kim, give me a call in the morning. Anytime between 8:30 and 9:30 in the morning Central Time. So,
Oh,
That's
There you go.
Joe's peak hours right there.
Yeah.
8:30 to is the first hour of the market. So whatever time zone you're in, it's the first hour of trading in the market. That's the
Yeah.
time to call
That's-
Joe.
that's the.
He's at his peak. After that, it's downhill.
yeah.
Alrighty, guys.
Sometimes I can fall asleep during that. So yeah.
There you go. There you go.
Pound on the microphone.
Okay, we'll see everybody.
Yeah, thanks everyone. Hey, thanks everyone for
Bye,
saving.
everybody.
Yeah.
On my way to baseball practice now. So
Okay.
All right.
we'll
Hit 'em
see you.
hard.
Take
All right.
care, everybody.